Good morning. This is Japanese Economic Review Channel. Welcome to our weekly macro briefing. Today's focus is the Middle East conflict, central bank gridlock, and asset volatility. With crude oil spiking and the Nikkei fluctuating violently, we will explore how cascading risks are shaping the market's search for a bottom. The US-Israel-Iran conflict and the de facto closure of the Strait of Hormuz have pushed crude oil past $100. This creates acute stagflation risks. Unlike normal recessions, central banks are paralyzed by inflation fears, leaving markets without traditional easing support. A quick ceasefire is unlikely, as President Trump delayed his China visit. However, markets anticipate a 4 to 6 week resolution. Even if prolonged, a hard political deadline looms on July 4th, the US 250th anniversary. We expect markets to eventually transition into pessimism fatigue. Central banks face a severe dilemma. The FRB maintained a hawkish stance due to sticky inflation. The BOJ also held rates but hinted at early hikes, warning that expensive oil fuels domestic inflation. This liquidity vacuum forces markets to digest geopolitical shocks without a safety net. The Nikkei is highly correlated to crude oil, with a forecast range of 52,000 to 55,000 Japanese yen. If geopolitics stagnate, the March 9th support at 51,407 Japanese yen should hold. Any concrete confirmation of a 4 to 6 week resolution timeline could spark a rapid relief rally. For USD JPY, we forecast a 156.00 to 161.00 range. Persistent US inflation supports the dollar. However, downward pressure comes from BOJ rate hike expectations and Finance Minister Katayama's warning of resolute intervention. The 25-day moving average at 156 acts as key support. Looking ahead, with central bank meetings cleared, near-term volatility will be driven entirely by data. We must monitor inflation and employment metrics, like US jobless claims, to gauge stagflation reality. Asset classes will remain highly sensitive to unscheduled headlines. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.